Good afternoon, Dan Casey, Panic Proof Retirement, coming to you from the Panic Proof Studios in Bloomfield Hills. Today, we're going to talk about long-term care insurance. Nobody likes talking about this kind of insurance, but it's a real need, right? 75% chance if you're over the age of 62 that somebody, you or your spouse, will need some sort of long-term care. And man, it can be expensive. I'm sure we all know it. We either have friends that have gone through this. We've had parents, grandparents, something, right? Here in the state of Michigan, $8,000 a month is about the average. Obviously, the average meaning there's quite a bit of facilities that are way more than that as well. And odds are, if you're 65 right now and you won't need this until 85, that's 20 years of inflation that you got to account for. So it may be 8, 9, 10,000 today, but it's certainly not going to be that way in a decade or two, right? So super important to have this coverage for a lot of people. Who doesn't need it? Well, there's kind of three bands I divide people into. Usually with people with maybe a couple hundred, $300,000-$400,000 in assets or less can probably position assets to qualify for Medicaid. If you're maybe $1.5 million, $2 million, $3 million or more in assets, you can probably self-insure, right? So if you've got that right in the middle, right? $400,000, $500,000, $600,000, $800 million, you know, it sounds like a lot of money, but if somebody has a stroke or a need for a long-term care right in the beginning of retirement, well, that can be catastrophic for the community spouse, as Medicaid calls it, or the spouse still living at home. So that's what we want to try to protect if we can, if it makes sense, right? Obviously, you know, we don't want to pay into a policy where we're going to lose it all if we never need it, which is where a lot of these, you know, the traditional long-term care policies have fallen short because people pay into it, never use it. And of course, all that money's gone, right? So there's a ton of other ways to do it now. And today I'm going to talk about the more advanced stuff of long-term care. What do I mean by that? Well, the common way I do it for a lot of people is if they do need income in retirement and they do want long-term care protection of some sort, well, then an income annuity will oftentimes make sense. The income annuity is the cheapest way to produce the most income, and it can potentially double if either you or your spouse needs long-term care, regardless of how it's funded. So if John's IRA funded the income annuity, Jane can still use it for long-term care. Both of them can, obviously. Okay, so meaning basically if the income annuity is scheduled to pay out 20 grand in 3 years or whatever, and you turn on that 20,000 in 3 years, and at some point need long-term care, that 20,000 can potentially double to 40,000 for up to 5 years. Now, I'm told by regulators and compliance people all day long, you know, anytime I sell an income annuity, it's important that I let people know this is not a long-term care insurance replacement. Okay. It can often fill the gaps, and for people who don't want to buy long-term care insurance, it can be a good supplement. But today we're going to talk about the real long-term care insurance, the real stuff, the one that if you go into a care facility and you want it fully covered for a very long time, then this is the kind of coverage that you're going to want that I'm about to show you. And the QR code up there is for the private Facebook group. That's where I answer all the questions, do deeper dives on personal questions, sometimes do case studies, jump in there. Being a private group, you do have to request to be entered. I'll let you in. And then you can see all these videos that I've done in the past. We are live now. You know, it's June 8th at 3:00. You can ask questions and I should be able to see them live, and I will answer them if you do. Very rarely do people do that though. But yeah, so let's go into a deeper dive. Now, what's important is these are real numbers, what I'm about to show you. It was a male 62 and a female 58. Okay, so these are actual figures that I'm going to show you, which is kind of cool. Okay, you know what? Let me go back and make sure that, there we go. I think that's better. Okay, cool. So hopefully you're seeing this page. It's a page that I developed to help make long-term care insurance easier to understand. Because here's the problem. There's now so many different ways to fund your long-term care policy. So aside from the income annuity I just told you about, if you want real long-term care insurance, there's a bunch of different ways. And it really depends on how you want to fund it, how robust you want your long-term care benefits, and do you want to make sure that your beneficiaries get something if you never use it. So to make things super simple, if you are like a lot of people that come to me and have all your money in just IRA money, then your choices are limited. You have basically one choice. Okay. Well, two choices if you want to, again, count that income annuity, because an IRA money that goes from an IRA to an IRA annuity, tax-free event, no fees there, no taxes, nothing. Obviously, when the income payments begin, that's taxable. So the other way to do it, if all you've got is IRA money, is one way that I'm about to show you. Okay, so that makes it super simple. But if you also have non-retirement money, either a lump sum or you just want to make yearly payments, then you've got a plethora of options. Okay, so I'm going to show you these right now, and hopefully, did I share my screen right? I do believe I did. Okay, so here's how we do it. So option 1 and option 1B is if you want to do a lump sum. And there's two ways they do it. One lump sum, you can buy like a whole life policy, is basically the underlying chassis. And then another one is the underlying chassis is an annuity. Both offer pros and cons. Okay, I'm going to show you those. Option 2, qualified asset funding. So your only policy you can buy if all you've got is IRA money. Option 3 is paid in age 95. So that's your yearly payments or monthly payments, however you want to do it. It's usually a little bit higher, but you're funding a whole life policy. So your benefits will be better. There will be something that goes to the kids usually. However, you've got to make payments forever. So the pros to that are you're not making a lump sum payment. So you've got, maybe that other money can grow for you and invest. And I think, did I do that? Somewhere on here, I thought I did compare that to like, what if you left the bucket of money in growing in the market and then just made payments? Would that be better if you just put a lump sum into the long-term care policy? Break even's usually around mid-80s, something like that. And then option 3B, Mutual of Omaha. That's your classic, traditional, best in class, usually long-term care policy where you just make yearly payments. Rarely is there any money there when you die if you never use it. And when you stop making payments, the policy's over. Okay. And again, this would be something where if you wanted to leave a bunch of money making something, that's what you'd want to pick. All right. So let's go down to probably, where should I go to from here? Yeah, here we go. This is a good screen. Let me see if I can make it bigger.